We wanted to put together a hour presentation and talk about finances in the area of the legal space, because one of the frustrations we see a lot of our solo practitioners deal with is they hear all of these terms. They hear profit, they hear taxes, they hear take home, they hear compensation, they hear draw, and they can't really make heads or tails of it. They get to the end of the year and they're like, well, I don't know how much money I've made. I've collected this much in fees, but I haven't actually taken home that. I know I still owe taxes on it. And so it can be very frustrating. And so what we wanted to do was reach out to this particular market, kind of give you a practical guide to understanding what you're really earning and what do all these terms really mean. So again, they teach when you go to law school, they teach you law, but they don't really teach you how to run a business. And a law practice actually is, in fact, that business. So, and you're getting pulled in multiple directions. So, with that said, so this is basically our clientele that we see. We see the overextended solo attorney, right? You're juggling work, you're trying to practice law, you're trying to meet with clients, you're trying to deal with possibly an office manager, maybe a paralegal or two. Your firm maybe feels profitable. Again, you've got cases that are coming in. Clients are hopefully paying their fees. You're able to get billing out on a reasonable tard, but your bank account doesn't tell the whole story. And so every month brings new questions because you're thinking, I'm getting more cases. Do I need to hire somebody else to come in? Do I hire a new associate? Do I bring in a partner? Can I take more money out? Do I need to make sure I have more funds in the practice in order to pay for maybe some expenses if you're taking a contingency case, for example? And you still have to pay your quarterly estimated tax payments to the IRS, and you may not have any idea what they are. So you're getting pulled in a million different directions. Oh, and by the way, if you're in a relationship, you've got to maintain that. If you have children, grandchildren, friendships, all the things that life throws out us, you're trying to navigate all of that as well as be a business owner. But most attorneys don't look at themselves as business owners. They look at themselves as lawyers that happen to own a business. And I know that sounds like a funny distinction, but that's in fact what most of our clientele, when they come to us, tells us, because they know how to practice law. When you get them in a courtroom, when you get them in front of clients, they know what they do and they do it very well. But they're completely blindsided by the back end on what is a profit and loss statement? What's the difference between why is it when I pay the loan on my building, I don't get a deduction for that, and not understanding some of those nuances. So that's one of the things that we wanted to talk about today is literally just showing you understanding basic finances of a small law firm. So why doesn't your CPA teach net profit? Again, it's not because they don't want to. They're overextended as well. And COVID changed the landscape of the entire accounting industry. Most CPA firms were built to basically just prepare returns, right? They were built to be compliance machines. You have to file a return, you have to pay your taxes. COVID exposed a big sore and a big area that was lacking that most business owners needed, was that they needed help understanding, hey, how do I apply for PPP or EIDL loans? And I got to submit all these financial statements. That was a lot to take on. But again, the backbone of the accounting industry from a compliance standpoint has been preparing returns. So you bring your receipts in, they prepare your returns, or you bring in your financials, they prepare your returns. It's a check the box thing. The second thing is they kind of assume you already understand. They assume when they use terms like gross revenue or net profit or distributions that you know what those terms mean, unless you ask them, well, hey, what is the actual difference between those terms? They don't really have the time to stop. They're just going to assume that you understand unless you speak up and say, I don't really understand how this differentiates from my take home pay versus what I have to pay taxes on versus what's sitting in my bank account. And then also, if you've got accounting software, and most attorneys do, but your bookkeeping gaps create blind spots. Because if your books aren't accurate, then your CPA can't give you reliable guidance, right? And so that comes down to the person that's actually entering in your transactions. How are they coding them? Because how they code them, if they code them incorrectly, they can be incorrect and it will cause you to have a bigger tax consequence than maybe you should. So what is net profit really, right? So what net profit is all it is. It's all the money that comes to your practice through revenue, not that comes into your trust account. If it goes into your trust account, once you've billed the client, obviously, then that's now recognizable fee income minus any of your operating expenses. So that's rent, software, insurance, marketing, salaries, pretty much much everything it takes to keep the doors open as long as it's not a loan. Once you have all your revenue minus all your expenses, that's what your net profit is. That is what you pay taxes on. And depending upon how you are structured from a tax standpoint, if you're an S corp or a partnership or you're sole proprietor, that magic number is what determines what your tax liability actually is. Let me go through what net profit is not. Net profit is not your salary. If you are set up as a what they call an S corporation and you pay yourself a W-2 wage, that is not net profit. It's also not your bank balance, right? So a lot of people just go and they check their bank balance and they think, oh, I've got $25,000 at the end of the year in my operating account. That's what I'm going to pay taxes on. No. And there are tons of examples I can give where a firm has been profitable. Their net profit has been, $150,000 and there's only $50,000 cash in the bank. There are lots and lots of times where your net profit is higher than the cash available by which to service your tax liabilities. Happens all the time, and it happens for various reasons. And so it's, again, your net profit is not revenue. It is not your top line. It's not the total amount of fees you collected. It's not what you billed and what you moved over from IOLTA. It's none of that. And it's not what you can take home, right? Because your profit gets divided between, you've got to pay taxes on it. You've got to reinvest it into the business, right? So if you're on this successful trend in your practice and you're getting more and more clients, but you need to add a head count, well, you got to have cash in order to do that. That might be cash from revenue, or it could be cash from lines of credit if that's what you want to do, is to expand. And if you want to take distributions, again, money you want to take out of the business to do whatever you would like. There's 3 different ways you can get money out of the business. There's owner's compensation, distributions, and what we call retained profit. Owner's compensation is exactly it. It is the W-2 income you pay. So you might have a payroll service like ADP or Gusto or QuickBooks, and you pay yourself a stated salary. And again, sometimes that salary can be, 10 grand one month, it might be 5 grand the second month. You can change it. But when you pay yourself a salary, income taxes are withheld, FICA is withheld, and the law firm actually pays its side of FICA and state and federal unemployment on it. That is W-2 wages, salaries that you pay taxes on. Second way to get money out of your firm is through distributions. Again, if you're an S corp, you want to make sure you're paying yourself reasonable compensation in order to take out distributions. So distributions are not subject to Social Security and Medicare tax, which is 7.65%. So again, when you take money out of the firm as a distribution, it gets a more favorable tax benefit, and it's for you to pay less in taxes. And there's some nuances to how you take distributions out and how much, but that is the second way you can take out. And then the last way is retained profit. And this is basically retained profit. This is cash that stays in the business, again, for reinvestment, or if you want to take it out for the following year in order to pay the previous year's taxes. So you need to make sure you understand these 3 different ways, because it's the foundation of how you build a strong, fundamental, solid financial planning. And so if you mix them up and you overpay yourself, or you might underpay your taxes, or we've seen clients that have come to us that they've done nothing but take distributions, and they've taken $250,000 worth of distributions, but they haven't paid themselves anything in W-2 salary. On their tax return, that's going to create a red flag. And it's not a question of if you get audited, it's a question of when. And that's, the IRS will look at you and say, you took nothing but distributions, but we didn't get our FICA and Medicare tax out of that. So that's one of those things where how you take your money out of your business is critical to make sure you're taking it out correct. So how are your taxes actually calculated? Like we said, it's calculated on net profit. Simply, you add back your owner's distributions, apply the tax rate, and then set aside your quarterlies. Well, that's easy for me to say that, but I'm a very visual person. I learn by seeing, I learn by doing. So remember what we said was that net profit of what you pay taxes on is not your revenue. And this client's financials, they had $500,000 that came in of net revenue. After all of that was $463,000. These are what we call direct expenses. Then they had things like office rent, utilities, office supplies, marketing, advertising. So out of this is what they pay tax on, this $159,700. Now, how do I get this 159,700? Simple. I take my gross revenues out of the firm minus all of my expenses, which total up to 340,300, and the difference is what I pay profit. Is the difference is my net profit. And that's the magic number that you pay tax on. So one of the things that we've developed has been a calculator that we like to use. You can plug in your information and it spits this out. So literally, so same example, 500,000 of gross revenue. My projected business expenses were 340,300. I'm going to say this is my effective rates here. We plug this in and then it automatically calculates what my total annual estimated taxes are. And then what is my quarterly tax payments and when are they due? So again, this is something that we offer to everybody. If they book a free consultation with us for 30 minutes, if you know this number, or if you pull up your P&Ls when we meet with you for that free consultation for 30 minutes, we're able to give you this to tell you this is what your suggested tax payments are. And these are the due dates by which they're due. They're due April 15th, June 15th, September 15th, and then January 15th of the following year. Does that make sense? So like I said, this is a super great tool that we've used. It makes it super simple because again, finances and accounting can get complicated quickly. Our goal and what our mission, what we feel like we've been called to do is make this simple. And again, old marketing professors, everybody has heard it, keep it simple, stupid, right? And so this is pretty much the easiest way that we can break down this is your income taxes. This is what we project your income taxes would be based on just your net profit. This doesn't assume W-2 income from a spouse. This doesn't assume other W-2 income that you may have from the practice, but we can figure all of that in. But this gives you a good idea as far as what is your tax liability on just your profit of the practice. So why is April always a surprise? Well, because most solo practitioners don't look at their financials on a monthly basis or even on a quarterly basis. When they look at them, they go, wait a minute, it's getting ready to, my CPA is bugging me to get stuff to them. Oh, I need to get this to them probably by March 15th. And they look at it in February of the following tax year. So what typically will happen is February of 26, a lot of law firms will start looking at, oh, wait, what did I do for 25? What did I actually pull in revenue? Why is this off? I haven't really reconciled my books, or maybe we have I even looked to see if things are booked correctly or anything like that? And then what happens is that because you've delayed and waited to look at your financials until the next year, you've missed any opportunity to do any type of tax planning that can mitigate what type of taxes you might owe. And you might be late on paying your quarterly tax payments. And there's a penalty for that. And they charge you interest. The IRS is going to get their money some way, somehow. And again, like I said, bookkeeping's behind. There's no strategy for quarterly tax payments. You don't understand cash flow versus profit, or you're just taking money out of the practice and not setting anything aside. So what's typically the result? A 5-figure tax bill with no cash set aside, and then you're scrambling. How am I going to pay my taxes? And one of the statistics we found out through Thomson Reuters was that 47% of solo attorneys underestimate their tax liability by at least 20%. So that's 20% that if you underpay, you're going to be subject to a penalty on. So getting at least in the ballpark of a couple $100 is critical so we can mitigate any of those tax penalties. So what's the safe take-home framework? So this is a pretty simple method. It's one of the things that we've used a lot with clients, depending upon their bank. But literally, we've had them open up 3 different accounts, right? We have them have their operating account. That's what bills get paid out of, whatnot. Then we have them open up a side account, typically a savings account, where we have them transfer a percentage of their profit every month into that account. Okay. And that percentage depends on kind of what we think their tax liability, what we think they're going to need in the future. And again, you can move that money back into operating, but what we find is to keep it simple. If it's in a separate bucket, there's a mentality of, oh, if it's in this separate bucket, I don't want to touch it. I know it's separated out, so I don't have to worry about, do I have enough cash in my operating account to pay rent, to pay my staff, whatever that is. And then the last account we ask everybody to open up is a tax account within the practice. And literally, depending upon the bank, they won't charge you anything if you carry certain balances, and there's certain rules about that. But literally, where you're taking 20 to 30% of everything you have coming in out of your net profit, and you're putting that into the tax account. So literally, when we go back and we look at those 4 dates that we need to submit your quarterly tax payments, or you actually need to submit those quarterly tax payments, then there's a bucket with funds deposited in there to where you're not caught off guard. You can at least go ahead and pay the IRS and say, here's your fair share. Let's, keep on moving. And again, this simple system completely eliminates the guesswork. You're always going to know what you can take out. You've got your W-2 compensation. And if once you've done these 3 items, if there's more that you want to take out and you can, then there's more cash in the business to do that. But it allows you to have clear visibility, as if you're like most solo practitioners and all you're doing is looking at your bank balance and looking at your IOLTA account balance and trying to figure out, well, have I caught up on billing? Maybe I haven't. Maybe that's why my trust account's got such a high balance, because I haven't caught up on my billing. But if you have this system in place, just 3 different buckets inside your practice, if you're still looking at your bank balances, this is the first step to kind of get you out of that dysfunctional rhythm of just looking at a bank balance to decide how much you're going to pay yourself, how much you're going to take out of the business, how much do you have for reinvestment. So your year-end action plan, we're sitting here at December 4th. We've talked about you don't want to wait till February to then decide, oh my goodness, I've got a tax problem, or oh my goodness, there were some other things that I could have done to reduce my taxes. Well, the first one is to figure out maximizing your deductions, right? If you have enough cash, if you can prepay some of your January expenses, right? So if you can prepay rent, if you can prepay insurance, software, any of that stuff, if you're on a cash basis as you file, if you can prepay it in December, you get the credit of that being a deduction in December, which again, a deduction just lowers your net profit, which is going to lower your tax liability. The second biggest thing is reconcile your books. If you've got an accounting software, if you've got a bookkeeper, or if you're doing it yourself on a spreadsheet, however which way you're doing it, you need to make sure you reconcile your books. Reconcile all the credit cards that are attached to the law firm. Reconcile all the checking accounts or savings accounts and the IOLTA account. Make sure, and I know they pound this onto you guys during CLEs, but again, making sure your trust account balance is correct is critical, because every state bar has a different consequence, but most of them will penalize you heavily, if not, depending upon how egregious it is, suspend your bar license. Again, that varies from state to state, but making sure your books are reconciled is critical in getting any kind of clarity about where you stand. Third way is to make sure you fund your retirement accounts. So again, most sole practitioners are on a cash basis for accounting purposes. So if you need to fund your SEP, or you need to fund your solo 401k, it's critical to make sure that those checks are cut by December 31st if you're on a cash basis. And then lastly, you want to make sure you're planning your January estimated payment, which is your last payment for the current tax year. You want to make sure you kind of have clarity about that and make sure you get that in. And again, get that in by January 15th. So if you can do these 4 takeaway items, April's going to feel less like a burden and a crisis. And it's going to feel more like, okay, yeah, I have to do this. Let me check the box. This is my compliance of filing my returns and paying my taxes. The question is, are you ready for financial clarity? One of the things that we're offering is that between now and the end of the year, we only have 5 more spots available. We're offering free 30-minute consultations where you bring your financials. We'll give you custom net profit breakdown. We'll personalize your tax projections, again, to your situation, looking at whatever sources of income that you have in addition to the firm. We'll give you your safe take-home number. So we'll give you what you can safely take home without jeopardizing your firm's financial stability or tax compliance, or look at how you've been paying yourself out of the firm, whether that's W-2, whether that's distributions, and whether that's just taking out profit only. Again, purely educational. There's no pressure whatsoever. There's no obligation at all. It's just valuable insights to make sure that you understand or have clarity into your firm's finances. And so that's really it. We figure the more we can get out here and educate people on how money actually comes into their firm and how's the best way for it to go out, then that means small practices can grow and thrive, and everybody's net worth goes up. You're able to pay more. You're able to hire more. But it's critical that that law firm owners and business owners actually understand how every dollar comes in and how every dollar goes out.